Okay, we're going to look at some stockholders' equity transactions here. We'll just jump right in, start with example one. End Company incorporated in North Carolina and is authorized to issue 100,000 shares of stock in its state charter. The company issues 5,000 shares of $5 par value common stock for $15 per share on March 1st. You guys, par value is just an amount assigned to the shares in the charter. Doesn't mean the stock would trade at $5 on the open market. It could trade for a nickel. It could trade for $500. It's no indicator of what it would sell for. But in this case, it's $5 par stock. Now, we will put shares on the books at par value. We'll record the increase in cash at the amount received. And then we'll have a new account, paid in capital in excess of par common stock, that the excess paid in capital will go into. And when I say excess, I just mean amounts above par value. So let's take a look at the journal entry. First off, what do we know? They're issuing 5,000 shares of stock as a way of financing operations. These would be equity securities as opposed to bonds, which are debt securities. So here, if you own a share of stock, of course, you own a small, minute, percentage of the company, right? Depending on how many shares are outstanding. So here they issued 5,000 shares for $15 per share, so they now have more cash, right? So we'll just say, 5,000 times 15, that gives us 75,000. That's our increase to cash. Of course, it's an asset, increases on the debit side. And we're going to credit common stock at par value. That's going to be our 5,000 shares issued times the $5 par. And then the additional paid in capital will go into our additional amounts received from stockholders. We'll go into a new account here, paid in capital in excess of par common stock. You guys, you could write out the account like this. Paid in capital in excess of par dash common stock or dash common or comma common. I just thought it might be helpful to see it written out the one time. We're going to abbreviate it with the acronym PICEP, but it's paid in capital in excess of par common stock, and that just describes what's in the balance of the account, right? When we receive more from shareholders than par value for the shares that are being issued, amounts above par value are credited to that account. Now, both of these are stockholders' equity accounts, and they'll both increase on the credit side. Now, that's cash coming in from a financing activity. And of course, the asset cash increased to $75,000, and in total, our two stockholders' equity accounts increased by $75,000 as well. Okay, now again, that par value is just an amount assigned to the shares in the charter. So a charter may not assign a par value. Instead, it could assign what we would call a stated value. So let's look at the same set of figures, but with a stated value rather than par. So note, if this were no par value with a stated value of $5, the entry would be made the same way. Now that's just, I guess, just a way of telling you in journal entry form that if there's a par value or a stated value assigned to the shares in the charter, then we will put the common stock on the books at par or stated value per share, right? So let's run through the numbers here. Of course, cash again is just 5,000 shares issued at $15 per share. Just multiply those together. And then the common stock goes on the books at 5,000 per share times the $5 stated value. And then the remaining credit, the other $50,000, is credited to paid in capital in excess of par common stock. And again, that's a financing activity. Assets increased and stockholders' equity in the two accounts increased by the same amount. Now, a third situation in issuing stock that could arise is if if the stock had no par listed in the charter, no stated value assigned in the charter, then we would just debit cash for the amount received, $75,000, and credit the common stock for $75,000. So those are just three different scenarios that you could possibly run into when shares of common stock are issued. The most common one, or the one we will deal with the most, is certainly the par value. And there, just remember, cash goes on the books at the amount received. Common stock goes on the books at par value, and then the amount that cash received exceeds par value by is credited to paid in capital in excess of par common stock. Okay, next we got what if N Company Incorporated issued 5,000 shares of $5 par stock for land? The stock is actively traded on the market at $20 per share, and the land is listed for sale at $120,000. Okay, first off, what's happening here? They're just trading some shares of stock, issuing new shares of stock, to an individual or another company in exchange for some real property, land, right? Okay, so the first thing I would point out here, the land is listed for sale at $120,000. Well, that's not going to be relevant for us. What someone is asking for a piece of land or for a building, what it's listed at, or the asking price, it's just not objective enough for the accounting record. So that's not relevant for us. That's what I would call just distractor information in the transaction there. So what do we need? We know that we want to put the land on the books at its we would normally put it on the books at its cost, right? Well, this stock, instead of trading it for land, what if N Company could have issued the shares on the open market at $20 per share, right? So what if N Company must value this land at 5,000 shares times 20 per share, right? That's what they think it's worth. Or they wouldn't have issued 5,000 shares for it, right? Because they could have issued those shares out into the open market and received 5,000 at 20 per share. I believe 100,000 is going to be the amount we want to record the land at. Excuse me there. Got a little tongue-tied. We'll put the land on the books at $100,000 because that's the value of the stock that we gave up to get the land. I say we. What if N Company gave up 5,000 shares of stock that they could have issued at 20 per share to get the land? So we're going to value it at that price. 20 per share times 5,000 gets you the 100,000. That's the cost we'll assign to the land. That's more objective, right? More of a fair market price for the land than the 120. They could have made up any asking price, right? but we know the 5,000 shares could have been issued at 20 per share for $100,000. So that's the cost we will assign to the land. Now the common stock is still going to go on the books at its par value, $5 per share times the 5,000 shares. So we'll credit common stock for $25,000. And then this account paid in capital in excess of par common stock gets credited for the difference, $75,000. So I wouldn't think that would be a particularly common transaction to run into, but it's certainly possible for a corporation to issue some shares of stock in exchange for real property. Now, what happened here? Our asset land increased by $100,000, and in total, stockholders' equity increased by $100,000. All right, let's keep moving here. It's your last video of the semester. I hope it's been a good semester for you. All right, example 2. Finals Corporation has the following stockholders' equity accounts on January 1, 2024. Okay, let's look at the accounts in their ledger for the stockholders' equity section. They've got, let's hold up on the transactions. There we go. Let's just go through these. Okay, common stock is on the books at $1,500,000, and it's $10 par. Okay, what do we know already, you guys? Common stock always goes on the books at par value, right? And the balance in this common stock account is $1.5 million. So what we can do is say $1,500,000 divided by the $10 par, and that's going to tell us that there are 150,000 shares of common stock issued. Right, because common stock always goes on the books at par value, and 150,000 shares times $10 would bring us to that $1.5 million balance. Okay, since the company began, how much cash have they received above par value for shares they've issued? Well, that would be $200,000. Wouldn't have to be cash, but at least property in excess of par value. And then you know at this point what makes up the retained earnings balance, right? When the company begins, it's zero. It's increased by net income, decreased by net loss and dividends. So those three total to $2,200,000. So that's where we're at to start 2024 here. And now we've got some transactions that occurred during the year they're going to want us to record. So the company uses the cost method to account for treasury stock transactions. During 2024, the following treasury stock transactions occurred. Okay, first let's talk about what is treasury stock. Well, that's when the corporation, in this case Finals Corporation, goes out into the open market and purchases some of their own shares that have already been issued. So those are shares that they have issued. They're being traded, right? And they go out into the market and repurchase some of those shares that they have issued in the past. Now, why might they do that? Well, one reason could be to give shares to employees in some type of stock plan, some type of stock compensation plan for the employees, or maybe they think it's undervalued. There could even be an effort to buy back a great number of shares to drive up the price. So there could be any number of reasons. But as we'll see soon, they can't purchase their own shares, sell them at a higher price, and call that a gain on the income statement. Instead, if they sell shares of their own stock, of treasury stock, right, their own stock that they've repurchased, if they sell it for higher than they bought it for, then that's just going to increase a new paid-in capital account or a new stockholders' equity account that we're going to look at here momentarily. All right, so let's go through the transactions. On April 1, purchased 10,000 shares at $16 per share. Now they're going out into the open market and repurchasing some of their common stock shares. So what do we do there? We're going to debit treasury stock for cost. Treasury stock shares go on the books at cost. So we'll say 10,000 times 16 per share. And we get $160,000, and that's our debit to treasury stock. And what did they give up to get the treasury stock? Well, of course, it says 16 per share. They had to give up cash, right? So treasury stock is a contra stockholders' equity account. It's going to reduce the balance of these other stockholders' equity accounts. So the increase in treasury stock decreases stockholders' equity. And of course, cash went out, so assets decreased. And then that's cash going out for a financing activity. All right, next, we sold 4,000 of these treasury stock shares at 18 per share. Okay. Well, first we're going to receive that much cash, right? 4,000 times 18. So 4,000 shares at $18 per share. That's going to be $72,000 that they receive. So that will be our debit to cash. But these 4,000 treasury stock shares need to come off the books at the same price they went on the books, their cost, right? So we'll say 4,000 times $16 per share, the cost, to get our credit to treasury stock. So the credit to treasury stock is going to be for $64,000. And again, that's our cost paid for those shares times the 4,000 shares that we just sold back to the investing public. So it's going to be a credit to treasury stock for $64,000. And all right, so at this point, we've got a debit to cash for $72,000 and a credit to treasury stock for $64,000. Now to balance the entry, we need more on the credit side, right? So this is going to be a new account. It stands for paid-in capital from sale of treasury stock, right? So if you wanted to type it out, just so you're able to see it, not abbreviated, right? Paid-in capital. Sale of treasury stock. So that's just, that account would be, it's a stockholders equity account, and it's of course going to increase on the credit side, and we'll increase it when we sell treasury stock shares for more than we bought them for. And it's easy to see here that we did that, right? We bought these treasury stock shares for 16 per share, sold them for 18 per share. Remember I said earlier, when we do that, we can't call it a gain on the income statement like Finals Corporation would had they sold some shares of Coca-Cola at a gain. That would show up on their income statement. But here, instead, it's not a gain on the income statement. We just increase a new stockholders equity account. And that one is called paid-in capital from sale of treasury stock. And we'll increase it here by $8,000, the amount it takes to balance the entry, right? We had a credit to treasury stock for $64,000, a debit to cash for $72,000. So it's just the difference in the two. Now, another way you can come to that number, we've got a $2 spread here, right? We sold it for 18 when it was purchased for 16. So you can say $2 per share is the spread there times the 4,000 shares sold, and that will get you to the 8,000 as well. Now that's going to be cash coming in from a financing activity. Assets increased 72,000, and stockholders' equity, when treasury stock is sold back to the investing public, stockholders' equity also increases by the 64,000 and by the 8 since it was sold for more than it was purchased for. Okay, next we've got a situation where they sold 4,000 more shares, but this time at $10 per share, so less than they bought it for originally. Okay, on this one, we're still going to debit cash for the amount received. That's not going to change. So 4,000 at $10 per share. This is probably overkill, but 4,000 times the 10 gets you 40,000. And that's our debit to cash, right? Cash increased by $40,000. Now, treasury stock needs to come off the books at its cost. Well, that's going to be 4,000 times 16. Or $64,000. We had its cost here too. So now we've got a debit to cash for 40,000 and a credit to treasury stock for 64,000. So we need more on the debit side. Well, the first thing we can do, see what happened here. We sold the treasury stock for less than we paid for it, right? By $6 per share. So that means our paid-in capital and stockholders' equity is going to decrease since it was sold for less than it was purchased for. So the first thing we're going to do is debit paid-in capital treasury. That's, again, just paid-in capital from sale of treasury stock. It was credited here for $8,000. We need to debit something here for what, $24,000. So the first thing we're going to debit is this paid-in capital treasury, and we're going to wipe out its balance entirely, and that's going to be our debit for $8,000. We can't debit it for more than its credit balance. So it's only been used, as far as we know here, by the company one time, right? When they sold the treasury stock for more than they bought it for, and it got credited for $8,000. Well, here when they sell the other shares for less than they paid for them, and stockholders' equity paid in capital needs to be decreased, well, we can decrease that account, but only to the extent that it has a balance. It had a credit balance for $8,000, so we can debit it for $8,000. Now its balance is zero. We just can't bring it into a negative or debit balance. Okay, so now you're maybe wondering, what other account are we going to debit? We've credited treasury stock at its cost, debited cash for the amount received per share, times the number of shares sold, and then we debited paid-in capital from sale of treasury stock for the $8,000 to wipe out its balance. Now, if you need more debit at this point, you guys, the account we have to use is retained earnings, our other stockholders' equity account available. And what do we need there? 16,000. And that balances the entry, right? So you can bring this account to a zero balance, but then if you still need more debit, you have to go to retained earnings. Now this cash is coming in from a financing activity, selling shares of treasury stock back to the public, and assets through cash increased 40,000. And stockholders' equity increased by a net of 40,000. It increased by 64 and then decreased by 24. Nets to 40, right? Now, those are just some treasury stock transactions. A few things to remember here. Treasury stock goes on the books and comes off the books at its cost. If it's sold for more than we bought it for, we can't call it a gain on the income statement. Instead, that excess is just used to increase the balance of a new paid-in capital account, paid-in capital from sale of treasury stock. Then if it's sold for less than we paid for it, we'd still increase cash by the amount received. We'd still take treasury stock off the books at its cost. But then the other accounts to debit would be paid in capital from sale of treasury stock for its balance. And at that point, if you still need more on the debit side, the account to make it balance, in this case, would be retained earnings. It's really our only other stockholders' equity account that we could debit it for. Right? So let's keep moving here. What's next? Example 3, what are dividends? Well, dividends are just a return of the profits earned by the corporation to their shareholders. Now, corporations never legally required to pay a dividend until the board of directors votes to pay a dividend. Once they vote to pay a dividend, then they are legally bound to pay it. So it's just a return of the profits of a company back to the shareholders. You know that by now, though, I think. We've talked about them quite a bit. All right, now in connection with dividend, we have 3 dates. First, the date of declaration. Now, that's the day the board votes to pay a dividend. All right, and on that day, we would record in the journal, we would record the dividends themselves and set up a dividends payable liability account. Now, you don't have to own the stock that day to be entitled to the dividend. You have to own the stock on the next date, the date of record. So whoever owns the stock on the date of record would receive the dividend. Maybe there's definitely some time between these 2 dates. That could, I think, vary corporation to corporation, but I typically think of it as a couple of weeks. That could be off, but there's definitely some time between the 2. And let's think about it. If the stock's publicly traded, it could increase between those 2 dates, especially if the declaration of the dividend was a surprise to shareholders. Then you would expect, since they know they're going to receive a check for every share owned, you would expect that to cause the price of the stock to increase between the date of declaration and the date of record. Then the 3rd date is just the day the dividend is distributed to shareholders' date of payment. Now, there's no entry required on the date of record, but on the date of payment, we would wipe out the dividends payable that we set up on the date of declaration. And, of course, we decrease cash for the amount paid to the shareholders. All right, the next one is almost done. Company is authorized to issue 1 million shares of $5 par value common stock. The company had the following stockholders' equity section of the balance sheet on January 1, 2024. All right, let's look at their accounts. They have common stock at $5 par, a balance of $2 million. Now again there, you guys, anytime you're given the balance in common stock and you know par value, you can determine how many shares the company has issued, right? So we could say here 2 million divided by the $5 par. That means they must have currently issued here on January 1, 2024, 400,000 shares. Okay, paid in capital in excess of par common stock, 500,000. That just means they've received 500,000 above par value for those 400,000 shares they've issued. And then retained earnings is $4 million. Again, that's just profit minus loss minus dividends since the business began. And then those three give us, when we add them up, give us total stockholders' equity. All right, and on March 1, Almost Done Company declared a $1.50 per share cash dividend. The dividend is to be distributed on March 31 to shareholders of record on March 15th. Record the necessary entries for the month of March. We're coming back up here, you guys. Our date of declaration was March 1st, the day they declared the dividend. The date of record, the dividend is to be distributed on the 31st to shareholders of record on the 15th. So March 15th there. And on the date of payment, it's to be distributed on March 31st. So there's your date of payment. Now these two weren't necessarily connected, I guess, but just a better way to maybe illustrate these three. So let's keep going with it. They're going to want us to make journal entries here. Well, on March 1st, the date of declaration, we're going to debit the dividends account or cash dividends. And how did we get to the 600,000? Well, it's our 400,000 shares issued and outstanding times the $1.50 per share. Now let's look one more time at how we got that 400,000. I just cleared it out of here, but it was to the $2 million balance divided by $5 par. That tells us that 400,000 shares of their stock have been issued, and they're also outstanding. We know they're outstanding because there's no treasury stock shares. We'll talk more about the difference in issued and outstanding just a little later. But we'll say the 400,000 shares outstanding times the $1.50 per share. And that's how we got to our $600,000 for cash dividends. And we're going to credit the liability account cash dividends payable. I named them both a little incorrectly. You could just use dividends here, but cash dividends differentiates between cash and a stock dividend. And then, either way here, dividends payable works, or cash dividends payable would be okay too. Now, what effect will this have on our balance sheet? Well, dividends are going to decrease stockholders' equity through retained earnings. And then the liabilities account, dividends payable, also increased. Now next, on the date of record, if you own the shares that day, you will receive the dividend on the date of payment, but no journal entry is required for that day. All right, then we have the date of payment, March 31st. You can probably see what we're going to do already there, right? We're going to pay the dividend. So dividends payable will come off the books. When on the books is a credit, and liabilities decrease on the debit side. So we'll debit dividends payable. And what did we give up? Well, of course, we gave up cash, right? So we'll credit the cash asset account for $600,000 as well. Now that's cash going out for a financing activity. Paying dividends is always a financing activity. And what assets decreased, cash specifically, and dividends payable, the liability decreased. All right. On July 1, the company issued 10,000 shares of common stock for $26 per share. Record the entry for the issuance of the new shares. Okay. Again, we will debit cash, right? You've seen one similar to this already. We'll say 10,000 shares times the issue price, 26 per share. So that's $260,000. That'll be our debit to cash. We'll credit common stock for par value, which was $5, times the number of shares issued, 10,000 shares. Well, of course, that's $5 par times the 10,000 shares. That gives us 50,000. There's our credit to common stock. And then we'll credit paid in capital in excess of par common stock for 210,000. The difference in our debit to cash and credit to common stock, or the amount of cash received above par value is credited to paid in capital in excess of par common stock. So what happened there? That's cash coming in from a financing activity. The asset cash increased and stockholders' equity increased. Okay, on August 1st, they declared a $1.50 per share cash dividend. The dividend is to be distributed on August 31 to shareholders of record on August 15th. Okay, again, just August 1 would be the date of declaration, August 15th, the date of record, and the payment date, August 31st. But you guys, we got a little bit of a change here, right? So let's go back to the top of the problem. When we started here, we took our $2 million balance in common stock and divided it by the $5 par value, and that told us we had 400,000 shares issued, right? All right, well, when we get to July 1st here, what we issued an additional 10,000 shares, right? So let's add that to the 400,000. So now if the company's going to declare a dividend, they have to pay it on the 410,000 shares that are issued at that point on August 1st, right? Back on January 1st, there were only 400,000 shares issued, but an additional 10,000 shares were issued here on July 1st. So on August 10th, this dividend being declared then is still $1.50 per share, but total dividends are going to increase because the number of shares issued and in the hands of the investing public is now up to 410,000. So we'll say 410,000 times our $1.50 per share. That gets us dividends this time of 615,000. We're going to debit cash dividends for that one on the date of declaration. We'll also set up dividends payable. Cash wasn't involved. The liability increased by 615,000, dividends payable, and then recording dividends through retained earnings decreases stockholders' equity. On the date of record, August 15th, no entry would be required. And then on the date of payment, just like you saw before, we're going to debit dividends payable for the 615. And of course, we would credit cash, right? We're paying the dividend. The liability dividends payable decreased by 615,000, as did cash. I think I just saw why they didn't put the extra zeros here. We'll just leave it that way. Sorry, my dog's making a little noise. I think he's ready to go OUT. I better not say it or he'll start going nuts. Hope that's good with the dividends, right? If the number of shares outstanding owned by parties outside the corporation increases, then we're now going to pay a dividend on all the shares that are out there, right? So the amount of dividends, even though it stayed the same on a per share basis, total dividends increased because the number of shares that are being paid on increased from March to August. All right, what's next? We've got almost done. It keeps promising we're almost there, right? We'll get there soon. On September 15th, Almost Done Company reacquired 5,000 shares of its common stock for $21 per share to hold as treasury stock with the intent to give it to executives as bonuses, right? Okay, so here we're going to debit treasury stock at cost. That's 5,000 shares at $21 per share. That'll be our debit to treasury stock, 105,000. And we gave up cash to purchase the treasury stock, so that'll be our credit for the same amount. That's cash going out for a financing activity. The purchase of treasury stock decreases stockholders' equity. It's contra to our other stockholders' equity accounts. And then cash decreased by 105,000 as well. On November 1st, Almost Done Company. Pardon that slip of the tongue there. On November 1st, Almost Done Company declared a $2 per share cash dividend. The dividend is to be distributed on November 30th to shareholders of record on November 15th. Record the necessary entries for the month of November. Okay, what's happened since August? Well, in August, we paid a dividend on the 410,000 shares. We had 400,000 shares issued to start the problem. Then they issued an additional 10,000 shares. Okay, but what happened on this last transaction? They went out into the open market and repurchased some of the shares they had previously issued, these 5,000 shares. You guys, if they declare a dividend when they're holding treasury stock, they're not going to pay a dividend on those treasury stock shares. That wouldn't make sense, right? Almost Done Company owns these 5,000 shares. Why would they pay a dividend to themselves? Are they going to write a check to Almost Done from Almost Done? That would make no sense, right? So if they own treasury stock shares, they will not pay a dividend on those shares. We had 410,000 shares issued and outstanding, which just means held by the investing public before September 15th. Now the company's reacquired 5,000 of those shares, so they're no longer outstanding or owned by parties other than the corporation itself. So those have to be subtracted out. So minus 5,000. That gets us to 405,000 shares outstanding. Now there's still 410,000 shares issued. 5,000 are being held as treasury stock, so only 405,000 shares are said to be outstanding, and that just means owned by the investing public rather than the corporation itself. So now for this, for our next dividend here, we'll only pay it on the 405,000 shares. Now let's go back down. I believe that was a $2 per share dividend. So times 2 gets us 810,000 will be our debit to cash dividends. And a credit to dividends payable, of course. That was on the date of declaration. The liabilities increased and stockholders' equity decreased. Remember, dividends decrease retained earnings, stockholders' equity account. And then on the date of record, again, no entry required on the 15th. But then on the last day of the month when they paid the dividend, we'll debit dividends payable and credit cash. That's cash going out for a financing activity. So assets decreased and the liability dividends payable also decreased. On December 15th, due to a change in stock value, the company decides to sell 5,000 shares of treasury stock for $36 per share to gain cash to use to upgrade equipment. I guess the Executive bonuses are out. Anyway, record the necessary entry on December 15th. Okay, so they sold 5,000 shares for 36 per share. So what do we got there? $180,000 will be our debit to cash. We're going to credit treasury stock. We're going to put it on the books at cost when we buy it. We'll take it off the books at its cost when we sell it. So let's go back up and look at what it cost per share. It was purchased here on September 15th at $21 per share. We're selling back 5,000 shares, so we'll say 5,000 times $21 cost per share on the earlier transaction. So we're going to credit treasury stock for $105,000. Now we need what? 75,000 more on the debit side, and that excuse me, we need 75,000 more on the credit side. So the account we're going to credit is, again, one you saw earlier, paid in capital treasury stock from sale of treasury stock. Or you can just put paid in capital treasury. That's fine too. All right, and then on December 31, 2024, how many shares of stock are first authorized? Well, that's going to be 1 million. Now, where did that come from? Way back up here. Almost done is authorized in the state charter to issue up to 1 million shares of common stock. The next question: how many were issued? Well, we've gone through this already, but let's look at it again. When we started the problem, we had a $2 million balance in common stock. Okay, divided by the $5 par tells us 400,000 shares were issued in the beginning of the problem. Then they issued an additional 10,000 shares on July 1st. So that gets us to 410,000 shares issued. Okay, so that's where we're at. Get back down here. There, right? So we were authorized by the state to issue up to 1 million shares. So far, the corporation has issued 410,000 shares. Next, they're going to want to know how many are outstanding or owned by parties other than the corporation itself. Well, outstanding shares have been issued and they're owned by parties outside the corporation. So any treasury stock shares would not be considered outstanding. So we had 410,000 shares issued and outstanding, minus the 5,000 shares of treasury stock that we purchased on the 15th. Gets us to 405,000 shares outstanding. And then, did we sell them all back? Yes, they sold back all 5,000 shares. I thought maybe it was only partial, so plus the 5,000 that we reacquired are now back to being outstanding again. So our number outstanding will also be 410,000. So at this point, we have 410,000 shares both issued and outstanding. The only time we would reduce what makes a difference in those two numbers is if the company owns treasury stock. If so, then those shares are not considered to be outstanding. They have been issued, but they're not counted as outstanding. Okay, you guys, we're going to finish this one up in the next video. I think this is probably our longest one so far, so just for uploading purposes, I better cut this one off at this point, and then we'll wrap it up in the next one. Thanks a lot. Please be in touch if you have questions.